Hey everyone, and welcome back to the channel. Have you ever set up a trade based on a standard volatility model, only to watch the market move in a completely unexpected way? It's frustrating, right? The classic models, like Black-Scholes, often assume volatility is constant. But we all know the real market is far more complex and dynamic. This is where understanding a more advanced concept can give you a serious edge: local volatility. So, what exactly is local volatility? Think of it as a volatility map of the market. Instead of one single number for volatility, the local volatility model calculates a unique volatility value for every single stock price and every single point in time. The telltale is that volatility isn't flat. It changes. It's higher for out-of-four money puts, what we call the volatility smile, or skew. And it shifts as the asset price and time to expiration change. This model essentially builds a 3D surface of volatility, giving us a much more granular and realistic picture of market expectations. By understanding this surface, we can price options more accurately and identify potential mispricings that simpler models would miss. Let's look at a classic case study to make this concrete. Imagine a company is about to release its quarterly earnings. The market is pricing in a huge potential price swing, right? A trader, using a simple volatility model, might just see high implied volatility across the board. But a trader using a local volatility model can see more. They can analyze the smile and see exactly how much fear or greed is priced in at specific strike prices. They might notice that downside puts are unusually expensive compared to upside calls, suggesting the market is more worried about a negative surprise. This trader could then construct a specific option strategy, like a risk reversal or a put spread, to profit directly from this skewed expectation, rather than just making a simple bet on high volatility. This is the power of seeing the market in high definition. Another great example is trading around major economic data releases, like a jobs report. Local volatility models can show you how the entire volatility surface is expected to shift after the announcement. Before the event, short-term volatility is incredibly high. But the model helps you anticipate the volatility crush that happens right after the news is out. A savvy trader could use this insight to sell options premium before the event, positioning themselves to profit as that inflated volatility rapidly deflates back to normal levels, regardless of which way the market moves. It's about trading the volatility dynamic itself, not just the price direction. So, how do you adapt your own strategies using this? It starts with data. You need access to real-time options, data to see the volatility surface as it evolves. Your first step is to move beyond looking at a single implied volatility number. Start observing the volatility skew for the assets you trade. Is it steep? Is it flat? How does it change when the underlying stock moves? By tracking these changes, you can get a feel for market sentiment. For instance, if you see the downside skew steepening day after day, it's a clear signal that fear is building up. You could adapt by adding downside protection to your portfolio or even initiating a bearish position. The key is to be dynamic. The local volatility surface is not static. It's a living, breathing reflection of the market's mood. Your strategies need to be just as agile, adjusting to the new information the market is giving you through its volatility pricing. Thanks so much for watching. Mastery. Local volatility is definitely a journey, but it's one that can truly elevate your trading. If you found this helpful, make sure to hit that like button and subscribe for more deep dives into advanced trading concepts. Let me know in the comments what you want to learn about next. See you in the next video.